Please welcome our session for today, Equity Strategies in a Shifting Market, Insights from the Investors Shaping It, moderated by Frederick Cooper.
Hi, everybody. Thank you for being here early this morning. Very excited to have a dynamic panel of folks here involved in a wide variety of elements of the industry. Hopefully give you some insights on what people are currently up to in what is an ever-changing environment, as we've heard over the past couple of days. I thought we would start just working our way down the panel, having people introduce themselves, and then we can get into a bunch of questions. Also happy to take questions from the audience. So do you want to start, Chris?
Yeah, good morning, everyone. I'm Chris Law, based in New York. I run my own family office in New York, Walton Investment Management. What we do is really providing the LP equity to the local sponsor on grant-up deals and acquisition deals. We really focus on multifamily, low-density kind of product. We love suburban area, top MSA, and good growth market. Currently, the geographically that we focus is from East Coast down to Florida, Sunbelt states, and mountain states. Kind of that's our LP strategy. We've been in the business for pretty new, about like 8 years. So we closed over 6,000 units in the past couple of years. So some of them still have something on, and there's another over 1,000 units that we're closing right now. And we have another strategy on the GP side where we start to buy deals ourselves. That's in Florida and Virginia. And that's kind of more focused on the core deal acquisition, but also low density product.
Hey, I'm Kelly Brine. I've been in the property management sphere for 25 plus years. I am the president of Rose Valley Management, Rose Valley Capital. We are a vertically integrated management company. We are a nationwide company. We have 10,000 units across the country, about 200 employees. We buy all asset classes, location agnostic. So if you have any deals, definitely come talk to us later. And as I said, we are vertically integrated. We do third-party management as well, work with multiple investors, family offices, and high net worth individuals. And we also are creating a vehicle for a fund, so definitely go talk to Ricky after the panel if you want to hear more about that. We've been around for about 30 years. We're a family-run office and generational company started by the Rosenthals. And I'm so glad that you guys skipped out on the end of breakfast to come listen to us talk today.
Hello, everyone. My name is Will Hutton with Intervest Capital Partners. We are a global alternative investment manager focusing on real estate, specialty finance, and asset-based lending. Since inception, we've invested over $25 billion of capital and are 100% employee-owned and controlled. On the specialty finance side, we are among one of the largest non-bank lenders in the country, with investments in over 28 portfolio companies, which themselves are all asset-based lenders. On the real estate side, we are a capital provider to sponsors, whether that is for real estate, equity, or credit, with a specific focus on housing assets, whether that may be multifamily, SFR, BTR, land banking, fix and flip, resi, NPL acquisitions. We are generally long on American housing and long on the American consumer.
Hey everyone, Mike Lebret. I head up the acquisitions team here at Machine Investment Group. Machine's a middle market private equity fund sponsor. Business was founded in 2020, spin out of a larger platform called Garrison Investment Group, which was a spin out of Fortress. We're investing out of our second fund. We have about $1 billion of AUM. Our mandate is distressed, special situations, and value-add investing. We're generalists, though. We invest in all asset classes, up and down the capital structure, across all geographies. Within multifamily specifically, since inception, we've acquired probably close to 3,000 units, predominantly distressed situations, and then also about 500 distressed condos.
Ray Kleeman, I'm at Pensum Capital. Pensum is broken up into two operating divisions. We have an equity arm. We buy, own, and operate a portfolio of just over 13,500 multifamily units, mostly value add. We're vertically and horizontally integrated in the sense that we do the GC work for the value add in-house, and we also own an equity interest in a third-party property management firm. So we brought that under one umbrella, and then we started a lending arm. We do pref and mezz behind other senior lenders, agnostic to who that might be, Freddie, Fannie, commercial bank, debt fund, life company. We can get to typically last dollar 80-85% LTV. And then we also do whole loans or stretch seniors. We effectively focus strictly on multifamily assets. Pretty much nationwide, I'd say probably Nevada, Utah, all the way to the East Coast.
And my name is Fred Cooper. I just retired in August after 32 years as Senior Vice President of Finance and Investor Relations at Toll Brothers, which was, by the time I left, we'd grown from 200 million to 10 billion over 32 years. So it was exciting and became a national company with a not only home building operation and land development, but national apartment development platform and an urban condo platform. So my current company, we're raising capital for companies, working on strategic growth initiatives with them, and both U.S. companies and international. So the way we're going to do this format, I'm going to raise questions, ask one of the panelists directly first, and then everybody else can chime in. But we have a whole series, and feel free from the audience if you want to raise your hands as well. Chris, so where are you allocating capital now? And I know you mentioned a new strategy that your company is exploring. Can you kind of go into that a little bit more as well, and why you're choosing now to do it?
Yeah, sure. So we continue to doing the LP investment, same thing as before on the multifamily side. But in the past, we do most like ground-up deals. But right now, definitely because of all those challenges, we towards a little bit more to the acquisition. So we actually done a couple acquisition deals with sponsor, and we wanted to continue that. But we will still both kind of run the ground-up investment and the acquisition investment because we just love ground-up. My father background is a condominium developer back in China, so we always wanted to build something and kind of create a building from like nowhere. That's something that we always like, and it also good for long-term hold. So both ground-up and acquisition. And the new strategy that we come to launch recently is the GP strategy, where we wanted to buy deals for ourselves. That's more like we wanted to create a cash flowing portfolio for the family. So that will only focus in Florida and Virginia. It just being, Virginia is close to New York. We're based in New York, and it's a pretty stable market. And whereas for Florida, it's a just big market. There's a lot of inventory, there's a lot of transaction, there's a lot of different type of capital, like always in this market, searching deals. So Florida will be another kind of hub that we want to improve our like GP strategy.
Well, you play across Class A, B, and C assets. Where are you finding the most opportunities right now?
Yeah, really, we are seeing most of the opportunity in the Class A new construction space or the Class B, workforce housing or naturally occurring affordable housing. Specifically within the Class A space, there's tremendous opportunity to buy new construction from, developers, emerging developers that candidly just kind of deliver the project at the wrong time of the market. They may have underwritten to a, return on cost that was kind of looked right in 2022, but in 2024, 2025, doesn't quite pencil, and they're kind of staring down the barrel of a cash and refi, and they may have syndicated out their equity and don't have the ability to do a capital call. They don't have the ability to tap someone like Ray for preferred equity. So we're finding a lot of good opportunities in that new construction space, but also within Class B, primarily workforce housing. There's tremendous opportunity to buy product that can be improved to a level to increase the rents, whether you're spending 5, 10, 15 grand a unit to achieve some rent premiums, but still stay affordable and still stay competitive within that submarket. And I'd say really within the, call it Class C space, where we've played historically is in the capital A affordable, mainly in New York. And I mean, I'll tell you, unless you're really buying Class C with an affordable play or strategy, it is truly difficult because they're generally older assets, heavily capital intensive. So what I tell people, especially within Class C, Don't look at the net operating income, look at your net cash flow, look at the past 5-10 years of CapEx, how much capital you have to reinvest in the asset, and that's kind of really, what you should be projecting going forward.
And how about the other panelists? Where are you playing along the A, B, and C spectrum?
I mean, for us, historically, we were pretty agnostic. I think we're just trying to figure out where is there less competition. And, a couple years back, there was nobody showing up for Class B minus C assets. And so we would show up to situations where we're the only equity group. Now that's tougher to find. We are kind of shifting more to Class A, big basis resets, where we can buy at a discounted development basis.
Yeah, we kind of see the same thing. We used to look at Class A will be more like the ground up deals. Class B will be kind of B minus, B plus, and then do some value add and turn it to a B plus or A minus. And after a couple of years, the time a little bit different. Like a lot of equity actually start to do like Class A deal, like buying something new, like below replacement cost, all those story. But we do believe because that so much capital fall into the Class A area, whereas Class B has less interest. Obviously, there's some reason behind it. But because of that, there's still some good opportunity for the Class B, as well as like Class C. I know your company is doing some Class C. We're a little bit hesitated to do Class C because in the current market, unless our GP has a very good like in-house construction team, the property management team, you are really able to manage everything in the right place. You're not really making any mistakes. Class C will be a great opportunity. But for us, like as an LP, it's very hard to kind of control that risk. So we've been very, very selective to choose to do the Class C. So we kind of more focus on the Class A, a little bit Class B, and some Class C.
I'll just echo what Will said. I think we've started to move up. I think 5 years ago, we were willing to do 1970 assets, vintage assets. We're no longer in the 70s. We're trying to push into the 85 or let's just call it later stage. I think the issue is people put R&M, repair and maintenance, onto their P&L, and they think it's the same, whether it's a 1960 vintage or whether it's a 1990 or whether it's a 2000 vintage. And I think that's very short-sighted, very myopic. You can't. And when we go back and we underwrite a deal in-house and we look at that and we say, okay, he's budgeting $1,100, we budget $1,800 per unit, and then we have this argument with the sponsor, but we know, we've seen enough. I mean, we have 45,000 units, so we're pretty thoughtful about what we see. So I would just tell everyone, it's great to take a B minus to a B or a B plus, and you get that cap rate compression for it, which is thoughtful, but you have to be very mindful of the CapEx that you have to put in to make it that way, as well as the ongoing repair and maintenance that you have to schedule to continue that at that level.
Yeah, I would just say that we're willing to buy across all different markets. It really depends on the story. Right now, it's not really a seller's market, and so I think each deal we look at really individually, and if there's a good story, then it's possible. But as you're saying, if you're taking a Class B minus to a B, it really depends on the market too, and the absorption rate, and whether there is room for that. And so you can't just automatically think that you're going to do value add in a market that's already capped. So I think as I said, we just look at it really locally and granularly and drill down to see if a seller is selling, why are they selling? Is it distressed? Is it the debt? Have they come to a place where they want to exit the market? I think the story is the most important, and kind of digging into that during the due diligence will kind of help lead you to whether it's a good deal or not.
Yeah, just to echo, again, pick up where you're going, a lot of people saw rent increases over a period of time, whether it was Florida, and that was a demographic change, or whether it was other states that have seen tremendous growth. And then the sponsor turns around and says, oh, I got $150, $200 rent bumps. And then they try to sell you on that. But that area has now plateaued. We're definitely not seeing the rent growth that we had seen or experienced over the last 2, 3, 4 years for sure. And I think as a prudent sponsor, people have to take that into consideration. Just because someone experienced 10-unit rent bumps and then they want to sell you on the other 90% of their portfolio. I think people just need to take a step back and really understand what the market is, particularly on the demographic growth. When you have $60,000 net incomes or household incomes in an area, it's very difficult to push rents on them.
Right.
It's another thing if it's $90,000 or $100,000. To push rents $200 doesn't mean that much to them, but in lower income, lower demographic areas, you just have to be mindful of how far you can actually push the rents on those.
And also taking into account policy change and red states versus blue states, it's all an emerging market for that.
Yeah, I mean, just to echo one thing that the panel has said here, raise your hand if you're achieving lease renewal trade-outs higher than new leases. A lot of people here. You know what that probably means? It probably means that the American consumer is stressed. That means, and I'm not here to sound the alarm bell, but that means that the cost of moving is actually materially impacting a renter's decision. So they'd rather stay in place, pay that incremental $50 to $100 a month, and have a 3 to 5% trade out versus moving out, finding somewhere else, uprooting their family, moving schools, and paying for moving.
But interest rates has also made them not want to buy. So that transient population that would usually rent and then buy, they're not leaving. And that's why renewals are so important, I agree, is making sure that you close the back door and you have your renewals and you start working on your renewal from the first day somebody moves in.
It also depends on the town, just to pick up your comment, Will. We are seeing people hop for concessions. I mean, Vegas is a great example. We're seeing a lot of people, because there's a lot of new product, who will go for a 2 or 3 month concession. They sign up for 12 months, and then that 12 months is over, and they see a nice new shinier penny. They jump for that, and they get another 3 month concession, and the cost to move is mitigated by the concessions. And we're seeing a tremendous amount of that kind of turnover. I think you're seeing it in markets like Tennessee, which is completely overbuilt. Places where there's tremendous amount of supply that hasn't been absorbed yet, we're seeing that in the market.
So Kelly, what do you manage a lot of units. What are the biggest mistakes you find owners are making in this current environment?
Not hiring my company. And me.
Is there anything else?
That's the biggest one, for starters.
That's a panacea, huh?
No, I think there's a bunch of mistakes that owners make, and they run the gamut. One would be self-managing when you don't have the infrastructure to be able to do it. It's a numbers game. I've had several people ask me this weekend, how many units do you need? There's not a direct science to it. You do need the infrastructure, you do need HR. A lot of people don't even think about that. They just think about hiring a building staff, but you need the accounting department, you need the HR department, you need all the infrastructure to be able to prop it up and to have a marketing team. So it is a numbers game, but it's about more than that. It's also about geographical location and proximity. Those things are really important. Another mistake that owners make when it comes to looking for a third-party management company or to partner with a management company and buy a building is they'll pick either the cheapest one, that their PMA agreement is very low, their fee structure, or they'll pick the biggest logo. Property that we're taking on, hopefully within the next month and a half, they called us because I won't mention names, but they have a really large third-party management company, and one of the questions they asked me is if we're on a call and we decide to change strategies and we decide to offer concessions, drop pricing, how quickly do you implement it? I thought this question was kind of comical because I was like, we implement it right after the call. Like, what do you mean? If you're going to change strategies, you don't wait, to change prices. You don't wait to offer concessions. You do it immediately. And they were telling me, well, the company they work with now, there's a whole process. They have to ask this person, they have to ask that person, get all these approvals, all the red tape. I mean, there's some benefits to being smaller, and that's one of them. You can pivot really quickly. And I think being able to move and change whichever direction you're going in is something that's absolutely integral in this type of market.
Yeah, we kind of interview many GPs and property management company as well for our own deals. we find out there's kind of two very important elements that we're really looking for, especially in today's like the AI world. One is about the tools that the property management team or the asset management team can build, because for the property management, there's a lot of information, there's a lot of conversation, there's a lot of data they have to absorb, and they have to come up with a result, and then they have come up with a solution. There's a need for a good system. It's able to be very, very efficient, to collect all those data, produce a result, show to the asset management or the property management for them to see what's going on and what kind of things that they can make for the solution. And the system have to kind of push them, okay, this is the solution, then you have to do it. And it's have to have a very good system to follow up those systems. So that's something that we see, like, I mean, most of the company they're using Yardi. Everyone is using Yardi. What does that mean? Are you really creating a good reporting system? Do you have a good approval system? Like, does that need to go through so many different layers, or is that already automatically built into the system? Is there a work order management software? Is everything set it up? So that's a very important element to the successful for property management. With those AI tools, I hope, like, hopefully there's a much better like property management platform or asset management platform can help that. And the other one is also super important, is about the staffing. So it's not like you hire a HR and you find a staffing company and put whatever person into the on-site team, because every single person in that on-site team, they have to know how to use that system, right? They have to kind of be aware of, okay, this is my property, I have to take care of that. Doesn't matter like how big or small of the company, as long as they have a good like staffing system, whatever benefit or compensation or structure or the system or the training to support those kind of staffing. Once that kind of build up a very good like staffing system, then the project will definitely be very, very successful.
Yeah, you could have the best tech stack, but if you don't have the people that can manage it, you can't just have smart tech.
Right.
You have to have smart
execution,
people, right?
Yeah.
It's made to enhance.
We've had issues with that, hiring big national brand name property managers, and really it's just about who is the regional manager and like how do you retain them.
Right.
I'm actually curious, how do you go about at the sort of micromanagement level when you manage a bigger portfolio? Like, how do you make sure you hire the right
it's hard to keep it local and keep it national at the same time. And I think it really comes from top-down leadership and the culture. The culture is everything, not to sound too cliche, but creating that culture of people first, and we're all one company, and you can, like, maintenance tech can call me at any time.
Right.
I'm the president of the company, and knowing that. And I'll give you an example. When I went to see one of our properties in Maryland, I met the property manager who, just this past week, we actually promoted to be a regional. Again, growth within the company. But one of the things she said to me I thought was so smart, and also just being there to listen, and she said, we have to train your residents. And I was like, okay, I know about training your employees, but to say you have to train your residents, I thought that was very insightful, because creating just not that culture within our company, but being able to translate that to the site, to the community, to have that culture of like, do the next right thing, do the next best thing. And like, they know when the office is open, they know how to, they pick up after themselves, they know how to do a work order, they know how to put it in. And that takes time, it takes guidance, it takes leadership. And we also have all of our regionals that are on site 4 days a week, which is very different than the larger companies, because that top-down leadership, I want them to have that oversight. And even if they're not working with them, even if they're working in an office, doing reporting and doing other things, they're there, they have a presence. And I think that presence is important.
Definitely.
The other thing we suggest highly is people secret shop their properties once a quarter.
Absolutely.
We,
and your comps.
We mandate that. We tell everyone, for instance, anything that we have exposure to, we ourselves go out once a quarter, and then we also have locals that we engage to just go out, make believe you're renting, and see what the process is. And then we give a report card back. Just because you get the best brand name doesn't mean you're getting the A team, right? Because there's A, B, C's, and there are F teams. And you need to make sure that—
We're the A team.
for sure, A plus. And so you just need to make sure that you're getting the best team. And if you're not, you got to cycle people out. And it has to be a harsh reality. But secret shopping, we really are big fans of that.
Yeah, I agree with that. The only thing I would say against secret shopping is I've hired regionals or property managers before where they've said, should I go secret shop before I start? And I said, absolutely not. Don't ever do that. Because if you go secret shop, the people that are going to be your team, you're going to create a culture of them not trusting you. Like you were trying to catch them doing something wrong. Don't catch them doing something wrong. Catch them doing something right. And start out the relationship like that.
I want to get into kind of distressed opportunities, which I know both Mike and Ray are involved in, but just you opened Pandora's box on this. AI as a management tool, there's probably a few of you, at least, who are promoting or marketing AI kind of integrated across property AI systems where, it can integrate can tell you if you're using too much water and if you've got leaks, and it's also, flowing into your pro formas, et cetera, et cetera, et cetera. A lot of different pieces to juggle and integrate and then provide a coherent report to you, et cetera. Are you finding yet that you're able to bring AI into the property management arena, and does it become an actionable product that comes out of it, and how you operate your property, even on the underwriting side as you guys are looking at deals? Where is AI playing a role yet, or is it not?
Yeah, I'll talk to it, but AI is everywhere. I feel like where 6 months ago we would ask when we spoke to different prop tech companies, do you have AI? We don't even ask anymore, because if you don't have AI, you're not in the field. You've already dropped out. And I recently got a list of 1,000 new prop tech companies that have come out. So I'm waiting. I feel like it's 2000 all over again, and I'm waiting for the prop tech bubble to burst, because there's just so much out there. So I think one thing that we're doing is we're constantly reevaluating our tech stack. We're constantly trying things out, because if you don't try it, there's just so much information. You want to see how it fits with your company, with your culture, not just your systems, right? Does this work for us? I'll give you an example of one thing that didn't work, and I won't mention the company, but you'll probably be able to figure it out really quickly, because I'm very bad at that. But they were AI and delinquency, so I'm sure you know which company it is. And we used them, and at one point, the bot had told a resident that they should seek mental health. So that's not great.
It may not be wrong.
What? So, and they might not have been wrong. There were definitely some curse words when I went back and reread it, so maybe the bot was learning, and they're like, I'm not going to take this shit, whatever it was. But we also realized, wait a minute, this could actually, I'm going to date myself by saying this, but this program can almost be replaced with just a mail merge program. This is just sending out information to our tenants. The problem is, if anyone's having a problem paying, you don't want to talk to a bot. You want to talk to somebody that you have a relationship with, that knows that your father passed away last month and you're dealing with unexpected bills, or you want to be able to have that conversation, and that's where you control debt, and you can't do that through a bot still. So I do believe it will enhance, it will get better. It'll be like 2000, where there'll be a lot that gets shaved off, and everyone's going to be using, I don't know what the next Google of prop tech will be, but we're all going to end up using a lot of the same things, and that's what I think.
Let's talk about the distressed arena. Michael, you're invested in distress and opportunistic situations. What are you seeing in multifamily, and how do you where does that deal flow come from?
Sure.
To you also?
Yeah, people are always asking us, where are you finding distress? Where are you seeing distress? It confuses us because, in the multifamily space, I feel like
everywhere,
every deal that comes across our desk is distress, and maybe that's just because they're targeting.
It's because everyone needs a story.
Yeah, exactly.
Everyone needs a story.
True, but most deals, I think, at a minimum, the equity is losing money, and the lenders probably should be losing money, but they're finding ways to not lose money. You look at the loan maturity wave that everyone's seen that slide a million times, and then DSCRs on all those loans are sub 1x, and so it just doesn't really make sense. But I think this time, lenders don't have a gun to their head to sell their loans like in the GFC. So we've had to manufacture distress deals. So we bought in end of 24 and early 25, probably 1,500 units of distressed workforce housing from CLO lenders, but it required us to cut a deal with the borrower, lender, and receiver in certain circumstances. because these were, big name syndicators that kind of checked out, and the asset was melting down because no one was paying attention, but it was in a tough mortgage foreclosure jurisdiction, so the lenders would understand that, if we can close quickly, they should move this rather than taking it, REO. But those deals, took 6 months to pull together and were, never had a certainty they would close. And that's all kind of dried up now. It seems like lenders have taken REO back and removed, meat on the bone on everything, just kind of leased it up incrementally or, cleaned up some CapEx, and now are offering, aggressive seller financing to try to get par or close to par. So we haven't been able to play in that space at all. It seems like people are capitulating more and things are coming our way, but we are under contract on a newer vintage deal in Austin, which is a big discount to the development basis, but obviously a really complicated market to underwrite through. And I think you can feel pretty good that it shouldn't get cheaper on a per unit basis, but it's challenging to figure out what is the stabilized yield there. But we feel good in certain pockets that supply is ending, and it'll compress more from an occupancy standpoint. So we should see some rent growth, and so we're trying to pick our spots. But that's kind of what you have to do to figure out how to get like a distressed entry point.
Will, how about you? Are you seeing that kind of flow?
Yeah, I mean, I'd say the trend that you saw, we've all, as Michael said, you saw the chart of the wave of loan maturities. And everyone was expecting a huge wave to hit now, but what a lot of people don't realize is that loan maturity that was supposed to hit in 25, 26, that was the initial maturity of the loan. So a lot of those loans have extension options. So the good loans with good borrowers that may be financially distressed in terms of the capital stack, but are otherwise the property is performing, the borrower executed their business plan, NOI increased, they executed the CapEx, but there's underwater from a capital stack standpoint. If those borrowers are able to, extend the loan, reinvest capital into the asset, we're seeing that lenders are willing to grant those extensions. But if those borrowers are not willing to bring fresh capital to the table, the lenders are saying, "Hey, pay me off, or I'm going to be taking the asset back." One thing I will tell you is, if there's no knock at brokers, but like if there's a publicly marketed investment sales process and they're saying, "Oh, it's a distressed deal," they're calling 50 people. That's not really a distressed deal. As Michael said, a lot of the true distressed opportunities, you have to manufacture those. You have to call the lender. They're true off-market opportunities.
And how do deals get in front of you then?
So how do deals get in front of me? So first of all, if you're a sponsor, you're welcome to reach out to me. My email is on my LinkedIn. I have to give a shout out to to Steve right here. Reach out to Steve if you want an intro. So I'm pretty easy to find if you want to present an opportunity to me. But really, what we are seeing, like oftentimes, like we'll have a lender reach out to us and say, "Hey, this is a situation. Is this something that you'd be interested in providing capital for? If not, do you have a partner or a sponsor that you could make a intro for?"
And Ray, on the debt side, how are you helping sponsors navigate refinancing of assets that were acquired in the 21, 22, as we've been discussing, and where they're unable to achieve cash flow neutral positions in today's financing market? Like, what are your solutions?
I'll say two things to tee this up. One, if I had a nickel for every call I got that says, "I bought something in 2022, 2021, and it made a lot of sense then, and I know I'm just about to turn the corner now, but can you help refinance us?" I'd be retired sitting on a beach right now. I get like 4 or 5 of those calls a day, whether it's from brokers, senior lenders, mezz players, sponsors themselves. And the other thing is an aphorism that we live by at our firm, which is time heals all real estate wounds. And so what we try to do when we look at these loans that are, let's just call it the deal is impaired, the equity is anywhere from slightly impaired to completely eviscerated. But we might believe that the thesis of the opportunity, if they can hang on for a few more years, they might be able to turn the corner. And if we believe that, then we're willing to structure something. It could be a loan or it could be JV equity that allows the sponsor to hold on and not get wiped out. We've done 4 of these, let's call it specialty solutions for some sponsors. We don't like to call it bailout or distressed because it has a bad moniker to it, or patina to it. But I'll give you a good example. I'll kind of walk through it very quickly. We did a deal in the Midwest. The sponsor did an unbelievable job on 1,000 units on a value add. He made the units are beautiful, but he self-managed. I don't remember who managed that earlier.
Really?
Yeah. And he basically took it from 92% all the way down to 68%. It's just horrible. And he bought it for $165 million. $135 million was the debt stack, and he had a $30 million equity check on it. The debt fund was willing to kick the can for a little bit, and that goes to Will's comment about people willing to try to figure out how not to take a black eye. But at some point, the senior lender just said, drag it to market. And so they took it to market, and the best bid they got was $135 million. So the sponsor was basically completely wiped out. But the sponsor came to us and said, look, if we can turn this around, if we can actually move the needle here, even to 85%, then this thing would be an unbelievable success. So we did a deep dive on it. We really do believe that he can turn it around. And what we did is we actually wrote him a check for $135 million. We did it as quasi-loan, quasi-JV equity. And what we did is, it was enough obviously to pay off the debt stack, and we gave him some extra dollars on top for some working capital and a little bit of CapEx that needed to get done. And then the $135 million, what we did is we broke it up between an A piece and effectively a mezz piece. We brought a senior lender to the table who did a $110 million senior loan. And then we wrote a check with one of our partners to do the rest of the stack. We structured that in such a way that if they can move the needle on the occupancy, then the sponsor has the right to buy us out at any time over the next 3 years. So if he moves that needle, gets to 85% LTV, he can take out our mezz piece, he can take out the whole loan, or he can sell the whole stack. It gives him all the flexibility in the world. So from his perspective, he didn't have to go back and do a capital call to his investors because he wasn't going to get the money anyway. He got a chance to live 3 more years, and then we helped him pick the right property management group to turn it around. And from our perspective, we love it at the last dollar. We truly believe that we're in at the right value. And if it works, amazing. If it doesn't work, it's okay too. So we're very open-minded in having how to structure these type of deals where we can be a partner to the sponsor and help them figure out a path that they can get a little bit more runway. We did a deal like that in Orlando, Daytona, Dallas, and Indiana.
Is that the deal you just referenced? Is that
Yeah,
Indiana?
exactly. Sometimes we structure it just as a plain loan, and sometimes we have to structure it as a quote-unquote acquisition, but it's still, at the end of the day, that sponsor has the right to buy us out at any time.
And given I've heard that there's 400 groups running around raising debt funds right now on top of all the debt funds that are available. How are you finding this, onslaught or wave of debt funds chasing deals impacting your ability? Do you have to really, it's the unique creative solutions that you can bring to a situation that distinguish you, or what's the
I think
secret sauce?
we're very blessed and we're very fortunate. The firm itself has an unbelievable long track record of 20 years of success. And so, but agencies chase us for business, the debt funds chase us for business. We're very, very blessed, we're very fortunate. And so on all of those deals, when we bring the whole loan solution to the table, we at Pensum actually sign on the loan. We sign the carve-outs. So we have a vested interest and we have real skin in the game. And I think that's what brings the senior lenders to the table. They look at it and say, well, if Pensum's on it, even if the sponsor gets wiped out, I know that I have a great sponsor who's going to step in and take over. So that's what differentiates us. It's the opportunity to have it all under one roof. It's the debt, maybe JV. It's the equity, maybe own it. So that gives people a lot of comfort.
What's the pricing on those loans? This is
Not cheap.
Yeah.
The senior loan the senior loan we just did was SOFR 255 from $0 to 110, and then our piece was 15%, and then we get a small participation in the back end if they get over that.
Got it.
Yeah, I mean, I would just caution everyone, if you're in a need for some sort of bespoke or structured capital solution, do it with a capital provider who's been in business for years. There's a lot of guys out there running around saying that they do private credit, saying that they provide pref, mezz, whatever it may be. They don't control their capital. They're going to go out, try to raise it, try to syndicate it. I know this because we provide this capital. People come to us all the time that really have no track record or experience providing structured capital solutions who are trying to provide it. And so if you need preferred equity, you hire a broker to go out and source a bunch of term sheets for you. And the pack of term sheets are all kind of within 25 basis points and so on. It's 150 basis points lower. And it's a new group. They say they have capital from overseas or some family office, but it's not really clear where the capital is coming from, and it's an outlier bid. Ignore the outlier bid. It's just going to be a recipe for disaster, and they're just going to waste your time.
Chris, what are you, I mean, some of these panels I run, everybody's bullish, and I'm starting to get nervous here on our discussion, but how do you integrate the downside risk as you underwrite new investments?
I would say because it's family's money and it's our own money, so the cost of capital compared with some other like institutional will be a little bit more expensive. So we are very conservative on the underwriting. Doesn't matter what market is that, the investment philosophy still stay the same. We may think the rent growth will be higher or lower. We can change all those assumptions, but we won't change only because we need to get a deal. So that part we keep the same thing. We kind of review. We have a macro study every single year, like our in-house macro study, to kind of tweak in order to tweak our assumption to make sure that we kind of alignment of the market. So that's one part. The other part is trying to be a little bit more aggressive to get deals, not the underwriting part, but to get deals. To really pushing the broker or the GP to send us deals, really pushing ourselves to find deals, pushing the terms to some level that make the seller or the GP make interest to our own capital. So that part we're trying to be aggressive. And talking about the risk associated with the aggressiveness, we are asking slightly additional terms from the GP protection. For example, for the ground-up deal, we always have cost overrun guarantee from the sponsor, which is pretty normal in the institutional world. But we're kind of looking for either a top-level company guarantee or the personal guarantee level. And we also request a real money in the game. So in the past, we do like 1585, and the sponsor put in 15, but within the 15, the sponsor might have 95% from the PE fund or whatever. They only put a very small number. We don't accept that right now. We kind of really require the sponsor, the balance sheet, the principal, or the employee put in the real money, majority of the GP. So that kind of one way that we're trying to minimize the risk, because as LP, we can't do much. So that's kind of one very important element that we're seeking from a sponsor.
And just, at Toll Brothers, I've known Chris for about a dozen years, when she was probably just right out of college. And we have done a number of deals with Wilton, and they're they're excellent partners. So very thoughtful, very detailed underwriting. So I appreciate what you just said. Because I think you really know what you're getting into.
Yeah,
I think when I was here, and then at MHC, and then at the MBA in 2023, I heard 2024 was going to be the year. And then I came here 2024, and I heard 2025 is the year. And now I'm hearing it's going to be 2026. And I think the
when you're saying the year, are you saying when the wave hits of
yeah,
resets, or that the
things
market...
are going to,
Get
The
better or worse?
acquisition market hasn't loosened yet. And I think Will made a really great point. There's no gun to the head of senior lenders right now. Stuff that's sitting in CLOs or sitting on people's balance sheets, everyone's trying to kick the can because if their debt is impaired, no one wants to take that mark. In 2008, people had to take the mark, and so that cleaned out the market. Right now, people are just not cleaning out the market, and so until something happens that forces this market to clear, I think it's going to be tough, and I think it's going to be challenging. I mean, I'm hopeful that 2026 becomes a better year. We're just not seeing enough acquisition flow. What we're seeing is a lot of refinancing. The acquisitions that we're seeing are from larger funds that can write large equity checks and don't need the same amount of leverage that people used to historically. And the amount of equity that's available, I used to call it tourist dollars. It's people who really didn't know the business. It was Europeans who just were looking for yield, and they were coming to the US for better yield, or whether it was people who were just looking for yield here locally, they were willing to throw dollars at real estate. I just don't think that that's available right now. So the market has slowed dramatically on the acquisition front. So 2026, here we go.
Let me ask you, with all the new entrants into the debt markets, when a property goes into distress, I've been through the cycle, the RTC cycle and the FDIC cycle, and at Toll Brothers we bought a lot of assets that way. But one thing I'm hearing is that a lot of these debt funds don't have the back office, and even a lot of the banks, they don't have the workout teams that, prior generations. So what happens? Do they just funnel it off to some, rabid law firm and servicer who beats the crap out of the borrower? Or what is how do things, if they can't keep postponing, who works it out on the side of the lender?
Yeah, I mean, if it's, and I'll answer your question more holistically, if it's something that's in a CLO, they always have special servicers. So I'm not picking on anybody, but Citus, for instance, will do a lot of that. And so you gotta make friends with the people there, and you gotta work through it. It's not always easy. Some of these debt funds that don't have the back office, those are my best customers because they're calling me up and saying, I don't know what to do with this. Can you help us? We even had a lender who came to us, let's just say they were an $80 piece or 80% LTV, and they said, well, if you come in between 60 and 70% LTV, come inside their loan, they'd be ever grateful, and then we'd get our return back, and then they'd get the return above it. So we try to think a little bit out of the box with those people. It's not easy because it becomes so competitive. And then what else you're seeing is when there is an acquisition, everyone gloms onto it. And that's how you've seen spreads compress so dramatically. 350 became 300 and 300 became 250. And now we're seeing 225 spreads on to SOFR. And that's not getting compensated for risk, right? That's just a spread return to their cost of capital, which is whatever their credit facility is. And if they can get 75 to 100 basis points between their credit facility and what they're lending out, that's a teen's return. And so I think that's a lot of what we're seeing in the market is people trying to make a spread game.
Yeah, I mean, part of what you're seeing is what I call a race to the bottom, where they're just purely trying to grind the spread down as low as possible in order to win the deal. And ultimately, they may not be getting a team's return. It might be high single digits. And depending on the capital source, they may be okay with that. And for other people, that's just way too low of a return.
So Kelly, when you, I'm imagining you get brought into these types of deals also where there's been, something's gone wrong, whether it's mismanagement or interest rates or what, but what do you do day one or even before day one when you jump in? How do you get your arms around this from a management standpoint?
Yeah, I think one part is the distressed debt, but then sometimes there's also the distressed asset or the operations that have kind of gone sideways. And I think not often enough do they bring in a new operator and switch it up completely. I think that would help in some ways. They just keep making the same mistakes, right? And they're focusing on the balance sheets and focusing on the NOI, but they're working on their occupancy to bring in leases and trying to heavy hit on leases, but they're totally leaving the back door open when it comes to renewals, or they don't have the right screening platforms in place when fraud has gone crazy the past couple of years. And if you're not screening them correctly when they come in the door, then you've got all these people that have come in and they actually don't have a job and they're not paying rent. And with regulations that have changed, it makes it harder and harder for evictions in some states and in some localities. So I think making sure you do your due diligence from day one, make sure you learn everything, and that means, not just what all the CapEx is, not just, all the mechanicals. Being vertically integrated is an advantage for us because we can work with our acquisitions team, the operations team, bring in our own maintenance teams to work alongside the engineers to check everything out and to see where the value add is. And we'll ask everyone on our team, everyone has to come up with at least 2 things of how you can make this building better. And it's incredible the things that you'll get out of your staff, just from the leasing agents to your maintenance technicians. I think just, being able to hear everybody and have everybody have a say and have everyone feel like they contribute to the bottom line, it really makes a difference.
So really holistic solutions.
Well, I mean, overall, and then, then you also have to be creative because some places they don't do, inside out from the buildings. I walk rooftops, I've climbed ladders, in the winter, maybe when I shouldn't have. But it's really important when you walk a building to go from the mechanicals, northeastern basements, all the way up to the roof, and it doesn't matter who you are. I went to go see a property once in Texas. There was a larger operator there, and I asked the regional, great, can I see the roof? Can I see the mechanicals? And they're like, I don't know how to get to the roof. You've been here for 2 years. You don't know how to get to the roof. I'm not joking. And we went to, their property manager, they didn't know how to get to the roof. What if you have an emergency and you have to get to the roof? The New Yorker in me always wants to know how to get to a roof. But yeah, it was incredible because it was the middle of winter, which in Texas wouldn't be that bad, except it was freezing. And I was also okay, I want to walk the grounds. They're it's really cold out. I'm I still want to walk the grounds. I need to be able to see everything. I found 3 leaks that day, which the owners really appreciated because I was this is going to turn into something much bigger. Plus, if I knew coming from New York that Texas was going to be so cold that I had to bring a puff jacket, then you should have known to turn off the water everywhere outside. And your preventive maintenance isn't something you just talk about, it's something you have to do. So I think being vertically integrated, but really even so granular as to within the operations, everyone taking a part. I know the weather in every locality of my properties, and I text people all the time. It's going to be colder. Did you make sure you do this? Let's run through all the things. It's just really important that ownership involvement, and that's why we manage all properties as their owner operators. We don't have a separate third-party division. Everything's managed exactly the same.
We have about 7 minutes, so go ahead.
Thank you so much for great insights. I've been seeing a lot of shift of pendulum demand moving to suburban red states and suburban product, garden style product. Do any of you guys have insights into the shift going back to urban areas, blue cities? Is that something that's part of any of your strategies?
Who here is brave enough to now go into New York City?
Yeah, the seller just won't let me buy it. No, I think, that's an example of a deal. We were under LOI on it at one point, and it was, I think, the day before the Democratic primary, which then no one was really thinking about what does that mean, and, Mamdani was elected, and you had to kind of recalculate what exactly could happen, and, I think we spent 2-3 months going, through every risk on a business plan, trying to see, how could this impact this specific deal, and there's plenty of deals in New York City that it could impact. That specific one, I think we leaned in on it. But I think the biggest question is, being in New York City, it's easier to lean into New York assets. But looking at a Chicago, or LA, like LA just, implemented a cap on rent stabilized rent increases, or really I think all increases. Chicago, like their property tax, I'm not sure if you guys are familiar with that, but the tax assessor just made it basically uninvestable of a city. Like since you cap NOI and that drives all of your return, when your taxes double and triple, like it's impossible to underwrite that. So we've sort of blacklisted Chicago. Like New York, I think is different because it has checks and balances at the state level over the mayor, where Chicago doesn't really have that. LA, the voters directly vote these issues in. So you can't really, I think some of those, New York is a different animal. Like it's got really interesting supply story, like free market rent growth should continue. And those risks are mitigated, but at the same time, everything that Mamdani puts out every time he speaks is literally terrifying. So I think capital's, run away from New York, at least temporarily. Maybe that's a great opportunity to buy, but we wouldn't probably buy in LA, we wouldn't buy in Chicago, in markets like that.
One day, right?
Chris, how about you? You said you do an annual kind of overview.
Yeah, but the reason that we moved from China to US because we're looking for a free market business environment. So from the very beginning, doesn't matter what kind of macro study that we do, we really focus on the open-minded, kind of business-friendly environment, which kind of lead us to focus in the market like Florida, North Carolina, Texas, not so much in New York, even though we're based in New York. So that strategy never changed, and I don't think it will ever change in the future.
Yeah, I know Chris has a dream about buying a profitable building in New York one day, and we'll manage it for you.
I think we have a question over here.
Hi, this question is for Chris and Will. Sorry to put you on the spot. I guess all the panelists spoke about the aggressiveness to try to find those opportunities that we're seeing today. Two-part question. This is a recent example that I sent to actually both of you in a deal in our pipeline. What's a good argument to or to not buy a deal that checks every single one of your boxes, but is maybe in a top 40 MSA versus top 20 or top 30? And then part two for you, Will, same question, but the deal is, the size is a bit smaller. It's 50 million, not, 70 or 80 million, and your check is 15 to 20 million versus 20 to 30.
Yeah, so overall for us, we always look at the top 40 MSA. That top 40 MSA is based on our own macro study, and then we kind of pick and choose based on our understanding of that market's demand, supply, and how business friendly it is. So we don't really change that criteria. And we think that kind of MSA, because MSA is kind of big, you're talking about Tampa, it's big, Orlando is big. In today's market, unfortunately, we have to go to see particularly sub-market. Each single sub-market is a little bit different, and we have to kind of study the shadow market of that sub-market to really find out the true supply, demand, the strengths, the weakness, like all those stuff. So we're pretty open to a lot of different MSA, but has to be specific to the sub-market story. Yeah, sure.
This is Greenville Spartanburg.
Sorry, where is it?
South Carolina.
Greenville Spartanburg.
Yeah.
It was number 39 as far as MSA.
Yeah, so again, that number, that 39 number is based on whatever company's report, may be different than our requirement because we're looking at a lot of different elements, and when we're putting a rank for different, we're putting the rating for different element, and then calculate what's the best MSA for us.
Yeah, and just to echo on that point, every research company has different data points, different market rankings. Ultimately, you can do your desktop underwriting, you can rely on CoStar or whatever market data source that you need. The best diligence you can actually do is boots on the ground, get in the market, secret shop. The best example I can give you is we recently did diligence on an asset that we were looking at acquiring, and the desktop underwriting was wonderful. The market data was phenomenal. Projected forward rent growth, no new supply and demand fundamentals were excellent. What happened? We secret shopped, we went to the market, we toured 4 other properties. We said, hey, we are a real estate developer, and we are started looking at building in this market in the next 3 to 5 years, how is everything, looking from a demand standpoint? And they said, well, things have been very tight in the past few years because it's very difficult to build in this, local market. However, there is a rumor that a very large employer is going to pull out of the market. And that's what a property manager told me, because they had heard from their tenants that their tenants were not renewing their leases and looking to downsize because they were concerned about a large employer leaving. So, rely on the data to make directional decisions, but ultimately before you make a multi-million-dollar investment decision, go to the market, tour the market, and actually talk to people, because your best intel will come from an actual human.
Henry, coming from the land of LA, what,
I know we're operating nearly 3,000 units in Southern California, and it's probably the best market in the country for us.
we have an LA transplant over here, so maybe you two can talk after.
So don't believe whatever you hear about LA, it's not true.
Okay.
You have to be inside to know it. But question I have is, we have seen a general absence of common equity. I've been doing this for 42 years, and 5 years ago, common equity was out there in the market, but today everybody and their mother and their uncle and their grandmother is putting out pref equity, including all of you guys here, under pretty erroneous terms, 11 to 15%. Has that come back at all? Do you project that you'll see more private equity giving you common equity in 2026? That's the first question. And secondarily, what bothers me is the disparity between interest rates when you borrow, because you still have the yesterday, the 10-year was at 4.13. I think today's a little less, about 4.09. We look at this every day. You're borrowing at Fannie Freddie like 5.25 now. And why is the 10-year keep going up while the Fed continues to cut rates? I don't understand this inverse relationship. So I wanted to see, the panel's, forecast on these fronts.
I'll jump in and hold on to your seat, because the first thing I'll just reiterate what I said earlier about tourist dollars. I think back in 2021, 2022, there weren't options for returns. Now there are plenty of options, right? You can go out and buy a 10-year and you can get a tax-free investment from the US federal government and make about the same cash-on-cash return that you can get in real estate. So people are trying to assess if I can get a completely liquid product versus something that I'm locked into for 10, maybe 15 years. It's a different paradigm for them to have to understand. I think, again, the people who are active right now are the large institutions who have raised capital, who have the opportunity, whether it's Chris's fund or Will's fund, and they have a long track record of success. But they're not going to just be throwing money into transactions like I think we saw historically. So that's kind of answer number one. Answer number two is, what I don't think people understand, and it frightens me, particularly for my kids, is where this country is going from a debt perspective. I mean, we have so much debt on our balance sheet. It's really shocking to the conscious. If I actually sat down and walked you through what our debt looks like and what our long-term liabilities look like, we can't cover it. It's like someone who goes out and just spends on a credit card and they spend 3 years ahead of what they're making. So what's happening is SOFR and the treasuries are not linked, right? I mean, inextricably, they're not linked. I mean, holistically, they might be. The Fed is trying to lower the rate because they want to send a message that everything is fine and good. But the 5-year, the 10-year, the 2-year, that's a trader's market. The traders sit back and say, okay, I need to assess separately what I think the risk is and what my return is for the risk, the quote, risk-free rate. If they're sitting back and saying, one, the debt is way too high. B, the number of buyers is shrinking, right? You used to have China and Japan, but they're reshoring their dollars. So they're not super active in buying the US treasuries anymore. So you're seeing a shrinking market.
Who's buying those missing treasuries?
Right, so who's buying it? You're actually getting America, right? We're buying our own, which, I mean, that's a whole other conversation. And then you are getting some of the large debt funds who are buying it and leveraging it. And that's why the movements are so dramatic in the 10-year, the 5-year, because they're going in there, they're leveraging their positions, and they can get a really nice return so long as it stays within a certain trading range. It breaks trading ranges, and you'll see wild shifts in it. So I think you've got a lot of issues that we need to clear, and what's going to happen is, whether you're Republican or Democrat doesn't matter, both are spending like wild sailors. And until that stops, we're just going to continue to eviscerate our own future. And so I would just say, I'm not a procrastinator. I can't tell you what's going to happen in a year or 2 years from now. But I will tell you that, unfortunately, the debt will continue to escalate. Whether we can get inflation at a level that will reduce the value of that debt, I'm not sure how we suffice that and how we address that. But my biggest concern is the amount of debt we have. And frankly, America broadly should be concerned about it, because other nations who used to buy are very concerned about it. Hopefully that answers your question. And it wasn't too long, you didn't fall asleep through that.
I didn't hear about the common equity question.
Any other questions?
I think I did. That was the first part. Okay.
Well, I guess I'll happily answer that question. So I think part of the issue why people believe the common equity is dried up in the market is really a lot of the funds that were deploying capital at the top of the market in 21, first half of 22, those assets are not performing well. So when they have to go back to the well, per se, to raise more capital, they're having a very tough time raising capital because their investors want to see their track record. The track record does not, look too rosy. However, not every group has that problem. But at the same time, the phenomena that you're seeing is people are very unsure about equity valuations. So they're pivoting to credit opportunities because they're saying, oh, I'm happy earning a 12 to 14% IRR in credit with a much more attractive attachments point versus maybe a 15 to 18, but the drawdown risk of that 15 to 18, that could very easily be a 6 to 8 IRR, whereas your 13 to 14 or 12 to 13, it's probably going to be 12 to 13, even on a bad day.
So you're saying, in essence, that a preferred equity position is really a debt position, a debt product.
I think debt is just it's getting crowded now, though, like the senior side, and then perhaps people are shifting into that. Eventually, as the 10-year stabilizes and sellers capitulate, people will look for more yield and more IRR, and equity should come back. So usually, it's good to see that debt is crowded right now, because I think the next step is equity.
Yeah, I mean, to really echo on what Ray said about tourist dollars, there's a lot of tourist dollars flowing into private credit, and within real estate, that means a lot of tourist dollars who want to play in preferred equity and mezzanine debt that just don't have the track record, don't have the experience. Now, when the acquisition market opens back up and deal volume increases, those tourist dollars will flow back into traditional equity opportunities.
I think we have a question in the back.
Just further on that point, with the common equity market shrinking, do you think people are becoming too reliant on the LTV they can receive on an acquisition and are missing out on opportunities to buy properties in great markets for possibly 65 or 70 LTV versus chasing the deals that size to a 75% day one acquisition financing?
So I'd say I'll take that. I guess it really depends on the equity and what they want. Are they chasing IRR? Are they incentivized by IRR? Are they more basis focused, or are they more cash flow oriented? It kind of really depends on the individual investor and their appetite. Everyone's different. Everyone has a different mandate.
How are you doing? I see we're 8 minutes over. I think there's another meal coming up, I hope. So thank you very much.